This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk and financial solutions.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Hi, I'm Chris Judd and you're watching Talk Your Book, and today we're lucky to be joined by Michael Goldberg from Collins Street Value Fund. Michael, returning guest, thanks very much for coming back on the show.
Chris, always a pleasure.
Now, we've got a gold stock to speak about shortly, but it's incredibly topical at the minute, gold, because it's just about the only sector that's ripping. So I thought maybe we could start with a bit of a brief overview of the gold market and what would have been the catalyst for change. So we might start with the changes to central bank policy that we've seen over in the US. How are you reading that, and how material do you think that's going to be going forward?
Look, I'm always hesitant putting too much weight into central bank policy. I know that we tend to fawn over every sentence and every word of central bank announcements, but when push comes to shove, they're fallible as well, they're humans as well. You know, it wasn't that long ago that the RBA said there won't be any interest rates until 2024, and that was the case until it wasn't. Until about 2 weeks ago, the Fed were saying we're going to continue to increase rates for the foreseeable future, until all of a sudden we've seen the issues that we've seen in the banking sector, and so that's turned around as well. Look, I think one of the challenges for central banks is that they are a hammer. They have one policy that they can impact, and so to a hammer, every issue looks like a nail. I think typically it tends to take 12 plus months for the impact of whatever they do to flow into the markets in ordinary times. And I think perhaps the advantage, if you could say there's a good thing that's coming out of the current circumstances, is that we'll probably now see a bit of a pause and give the market a moment to, I suppose, digest what we've seen over the last 9 months, and perhaps see a bit more clarity on the other side to really understand what the impact is going to be of these massive rate rises.
And unless you've been living under a rock, you'd be aware that there's been a banking crisis in the US that's now spilled over into Europe as well. How are you reading that? Do you think it will be contained in the US to the regional banks? Do you think it's done, or do you think there's more to play out from here?
Look, it's a really interesting question. I think as an Australian, when we hear the headline of a bank falling over, it's awfully frightening. It's not the sort of thing that we've had much experience with in Australia. I think in America it's much more common than people perhaps recognise. I think if it was a regional bank in the middle of the Midwest, no one would really care about it. We wouldn't really be hearing about it. But given that Silicon Valley Bank is a pretty big bank, I think it's the 16th largest in the States, given that it's on the West Coast, and given its massive exposure to a lot of growth stocks and Silicon Valley type businesses, I think it's really caught the headlines. But I think it's worth pointing out that there are a couple of specific things about Silicon Valley Bank that are distinct to it, and perhaps the contagion might not be quite as bad as we might imagine it could be. I think firstly, their customers are almost like a monolith. They tend to move in unison. They're one sort of type of banker.
And that being VC founders.
Correct.
And investors.
Tech stocks, growth stocks, new stocks, you know, the sorts of businesses that are looking for growth capital. I think they're also very well informed, and so when a bank run starts, it spreads very, very quickly. I think the other challenge specifically for SVB is that they saw exceptional growth over the last few years. And so ordinarily, if you're a normal bank and you start to see more inflows into your deposits, you could allocate that capital appropriately to different sorts of investment classes and different spaces and sectors. I think the problem for SVB was that they grew so quickly and they all of a sudden found themselves with so many deposits. They had to find a quick and easy place to put them. And of course, they put them in government bonds at 1% per annum. Now, the problem there, of course, is, you know, if you wait until maturity, there's no issue with their balance sheet. The problem is a liquidity issue. And so when a bank run began, and all of a sudden they were forced to fulfill those deposit requests, they had to go into the market and sell these bonds that at maturity would be worth, you know, 100 cents on the dollar. But given the rapid rate of interest rate increases, those things were down 30, maybe even 40% in some cases. So all of a sudden, a liquidity problem turned into a capital problem, and that's why we've seen government intervention in SVB, in Silicon Valley Bank specifically. And there's even talk about guaranteeing deposits across the entire banking sector in America. So I'm not sure I like that idea. I think there's always that moral hazard if you're backing up banks for their mistakes. But it's probably the lesser of evils to see some stability in the sector rather than to see ongoing confusion and contagion.
And we've got a new acronym being introduced by the US Central Bank. BTFP, I believe, is the recent one. I only know what some of the nicknames people are given it. I don't know what it actually stands for, but it basically means we're going to buy your bonds that are underwater at par.
I know. Can you believe it?
And it's got a 1-year period currently, but maybe talk through the potential ramifications if that temporary program gets extended into a permanent program, and if it potentially could one day end up fulfilling the role of QE, albeit in a different name and with the bonds initially being bought by the commercial banks, whilst the government ends up providing a level of asymmetry, e.g. if they go underwater, we'll buy them back off you at par, and if they don't, you'll continue to fund our deficits.
Yeah. Look, are we going to pretend that the banking system in America has a moral compass? Because I think the outcome will be different depending on what you decide. But assuming a moral compass, hopefully this will be a process that gets them through and everything will be fine on the other side.
But it's all more than that. It's really just becoming an extension of the US government is what it's starting to look like, don't you think?
Well, they're buying back bad debts, basically. I mean, I feel like we're getting echoes of 2008 over here. It feels to me like the banks get a free kick. If they manage to pick the direction of interest rates correctly, then they'll make a profit. And if they don't, they can just go and sell their bonds back to the Fed. So yeah, it does have a feel of QE. It does make me quite nervous when we start to see these sorts of things. Again, it'll probably bring calm to the market, and that's the intent. But in terms of rewarding certain types of behaviour, if you keep rewarding the banking system for poor behaviour, then you can imagine they're going to continue to behave in the same way. So it is a worry. It is a worry, but it's the world we live in.
That's right. When people say the Silicon Valley executives that chose to add duration risk when the other side of the balance sheet was really highly speculative loans to VC and tech startups. I mean, they do that because they know they're going to get bailed out, or they usually are. And I guess these decisions just continue to reinforce that. But enough about that. You're obviously starting a gold fund separate to Collins Street Value Fund. So you obviously believe it is an interesting sector, not just for a trade over the next 3 months, but I guess for a longer term period than that.
Yeah, I mean, the truth is that we were talking about this for quite some time and probably didn't intend to launch it for a few months at the very least. Our thinking basically was that, gold obviously acts as a pretty good security safety net against stupidity and distrust. But it performs especially well when you find yourself in negative real rates sort of environments. So our thinking was that inflation is, I wouldn't call it quite out of control, but it's certainly high by historical bases. The Feds and the central banks are doing their best to increase rates to potentially bring down that inflation rate. But our feeling was that consumers would sort of reach a point, and the business world would reach a point at which they couldn't stomach additional rate rises. And our initial sense was that we would wait until the Feds and central banks of the world didn't raise rates anymore and sort of came to terms with a higher rate of inflation for the medium to long term. We thought that would be a few more months at the least. But of course, the bank collapses both in the US and Europe have brought that to a head. I think I mentioned to you earlier, we were going to see rate rises for the foreseeable future until all of a sudden we're not talking about that anymore. The Fed came out and said likely to be a pause. There's talk now of when rate cuts might happen. So it's a very different environment today relative to what it was just a couple of weeks ago. I don't think what we're seeing is surprising in terms of an eventual shift. I just think the rapidity of that shift has come quicker than we expected. And so we're looking to take advantage. We're looking to get set in a basket of gold companies, both local and globally. And we think that over the next couple of years, it's likely to do quite well.
And we will get to your stock pick in 1 second. But do you think the Fed were raising rates to squash inflation, or raising rates enough to still make their treasury look investable whilst maintaining inflation so that it can eventually inflate away their debt to GDP issue?
That is a good question, actually. We've talked about inflating away their debt as a process within the office. To suggest that that's the case is an uncomfortable proposition, especially for lenders, rather.
That's right. That's right.
I'm not clear on what the Fed's mandate is. I know in Australia, the Reserve Bank's mandate is to manage inflation, and I believe that's the primary goal of the Fed as well. I think with a secondary consideration to the general environment, the general economic environment.
Yeah.
So I'm going to say, at the risk of sounding like a dupe, that no, they were just looking to get inflation under control. But being a suspicious type, I, at the back of my mind, I do wonder.
I like it. Well, let's get into your stock pick. Which stock did you want to dig deep into today?
So it's a small cap company listed on the Australian market called Black Cat Syndicate. BC8 is a stock code. They've got a market cap of about $100 million. And it feels like just about every other week they come out with a resource upgrade and update. So they've really got three main mines, and they're all in WA. I don't know how your geography is. Mine was not great. But when I had a look at the map, I don't think you could find 3 mines all within the state of WA that were any further apart. You basically draw a triangle, and they couldn't possibly be any further apart. So, one's in Karratha, one's in Halls Creek, and one's in Kalgoorlie. So literally the 3 ends, well, essentially 3 ends of Perth. Now, I think as recently as about 4 or 5 weeks ago, they came out with an announcement after providing an update on their Coyote project, which is in Halls Creek, declaring to the market that they have 2 of the highest grade mines in the country, right? So they've got tier 1 assets in my mind, in a tier 1 jurisdiction. We're talking about gold grades. I don't know if you or your listeners or your watchers have much experience investing in gold, but to my mind, if you've got a resource that's generating a gold grade of 1.5 to 2 grams per ton, that's economic. Mm-hmm. More than 2 grams is starts to get exciting, and more than 3, and I'm not sure if you can call it a bonanza, but you're getting within those realms.
I think bonanza would be thrown around. I think
bonanza is a very popular word in some ASX announcements that I've seen recently. So in their Paulson project, which is the one in Karratha, they've got about 250,000 ounces of resource at a grade of, get this, almost 11 grams per ton. Like, that is out of control impressive. Coyote, which is out in the middle of nowhere near the Northern Territory, has about 350,000 tonnes at about 14.5 grams per tonne. So we're talking about incredible gold grades. And it's not, some of it is in the middle of nowhere, but they also, certainly Paulson and Coyote, have serious infrastructure already in place. So we're talking about a business that expects to be able to ramp up in the next couple of years to about 150,000 ounces per year. They've got about 2.5 million ounces in terms of resource. Management have done this all before. I mean, I'm sure we'll talk about management in a moment. They've aligned their interests with their investors, and from a valuation perspective, certainly there are many ways that you can value gold stocks, but one of the popular ones is EV to ounces in the ground. And if you look at their competitors in the market in general in Australia, I think we tend to run at around about $80 per gram per ounce. Black Cat is trading at about 44. Yeah. So if it were your average Australian listed company, it should probably, on that basis, be worth almost twice as much. My view is that it's not your average gold company. Again, I think management are very competent. I think the projects are very exciting. And again, recognising that it's early stage, small cap company, so there are risks inherent with that, we quite like the business, and I'm very excited to see what happens even in the next 12 months.
And if we have a look at the price action provided by the market tech graph, it looks like most small cap ASX gold developers at the minute, in that it's been trending downwards to sideways over the last 12 months. When you compare this to the larger cap gold codes that are spinning out gold and spinning out cash flow, they're poles apart, and the miners have generally missed out in this rally so far. Is that something you're seeing that's been common across, a difference, if you like, between the larger cap gold producers and the smaller cap developers and explorers? Yeah,
Chris, I think the so far is the key point here. I think it always takes time for the market to come to grips with the likelihood of a gold rally being sustained. And so if you're looking at GOLD, which is essentially an ETF of gold, that tends to move in line with gold prices, and you see the benefits straight away. Shortly after, you tend to see the impact on producing gold companies, because they can get that gold to market, they can pour that gold and sell it at the new prices. For smaller cap companies, certainly, that aren't quite at the stage of production, it does take a little bit longer. Markets have to get comfortable that gold prices being high are going to be sustained high and perhaps go even higher. And what you tend to see, at least historically, and we all know that past performance is no guarantee of future results, but what you tend to see historically is that you get gold prices going up, then you get the big cap companies with production following in close pursuit, and then after a delay, you tend to see the smaller cap companies that really do have much more leverage than the bigger companies do, because there's a lot of upside if gold prices do go up. But it takes a little bit of time, I think, for the market to get comfortable that we're in a new environment where gold prices are moving higher, and then to ascribe that value to those smaller cap companies.
And you mentioned their Paulson's deposit and how high grade it is. I believe the initial high grade is underground component. Is the whole thing going to be underground, or you expect it to be, or will there be an open pit component down the track?
So we had a chat with management a little while ago, and their feedback was that they expect to have a little bit of column A and a little bit of column B, depending on specific results they get back, I think in May, so not that far away. Those new results, those new upgrades or updates will sort of frame how they pursue things going forwards. It'll impact costs, it'll impact the way they go through the process. But certainly, to my mind, I believe, having had those conversations, there'll be a little bit of underground mining, and there'll be a little bit of open pit mining.
And talks to it, I believe they're going to make the decision to mine Paulson's at the second half of this calendar year. Is that right?
So again, I think my understanding is that it's dependent on the results they get in May.
Yep.
So my expectation is that, yes, they'll make a decision at the back half of 2023, and that if everything goes according to schedule, they could be in production as early as the first half of 2024. Keeping in mind, both Paulson and Coyote, they're not brownfields. They're not starting from scratch. These are mines that have a long history. I mean, Paulson specifically, was bought from Northern Star Gold. They were producing as recently as a year and a half ago. So it's, I'm not saying it's easy, certainly, but it's less difficult to turn on a mine that's been in care and maintenance than it is to start up something from scratch. And they've got the mill there and the production facilities and the roads and the camps and all those other sorts of things that you need to have to really ramp things up. So,
and I know you need more data or the company will need more data to give an exact figure, but just back of envelope sort of numbers, ballpark, what would it cost to switch Paulson's back on?
You ask wonderful questions, Chris. The answer is that I don't know what it's going to cost to ramp things back up. I don't even think management are quite sure yet. Again, I think that they're waiting on the results in May to sort of guide their decisions. But I think it's important to remember, we're not talking about an unknown resource. So there will be opportunities to raise capital if it's needed from a multiple number of sources. They could do an offtake agreement, they could do a royalty agreement, they could do bank borrowing if they can get away with that. We're not big fans of equity raises, and I know they did an equity raise just a couple of months ago, so they should be good until they need to make the next decision. But if push comes to shove and share prices go up and they're more appropriately priced, then yeah, an equity raise could potentially be on the cards as well. I think we'll have a lot more clarity in about 8 to 12 weeks.
Beauty, mate. Well, it's a very opportune time to come back and sit back down with you and learn about another Aussie gold player. Thanks very much for coming back on Talk Your Book.
Chris, always my pleasure. Now, before I let you go,
yes,
if I might, my brother was tidying up his house just last week, and he was going through some of the kids' toys, as you do from time to time. And him being a rabid St Kilda fan, he could not abide by other club little men and flags being a part of his kids' setup. And so he took a photo of a couple of these toys and said, "Does anybody have an interest?" And I said to myself, you know what? I might know someone who might have an interest.
What have you got? This is unscripted, everyone, by the way.
In one of these toys. And I don't know how you can get this on camera, Chris, but I bring this over to you.
Mate, you wouldn't want to give that away. Look at that.
So it's a Chris Judd footy Lego man with a pretty good drawing on the front and number 5 and Judd on the Guernsey at the back.
I reckon that would have gone up a lot in value too. That's a big error he's giving that away, so thank you. Thanks, mate. The kids will love it.
My pleasure.
Cheers.
Okay.
This episode of Talk Your Book was proudly brought to you by Honan, who go beyond a transactional insurance broker to deliver better outcomes for their clients. If you're enjoying Talk Your Book, make sure you subscribe to Chris Judd Invest.